So, Mark, let's talk a little bit about copper. Is your copper royalties, are they paying as of right now? Just clarity on that.
Yeah, so the copper royalties we have today generating income for us are number one, Mantos Blancos. And that one in the first half of this year generated just under $4 million. The second one we have is Mimbula. We just bought this royalty. This one is probably what we generated in H1 is certainly not reflective of the true earnings power of this stream, this copper royalty, simply because we didn't have it for the entirety of the H1 period. So you can't really do a like for like comparison. But also the team at Mimbula is undertaking an expansion. And that expansion is to take copper production capacity from 14,000 tons a year up to capacity of 56,000 tons, or 14,000 tons last year is actually what they produced last year. It's not necessarily the capacity of the operation currently. So at full production capacity, and if you assume $10,000 per ton copper, Mimbula generates a run rate in the order of 10 million per year. And we have a royalty over a mine in producing in the United States, Carlota. This is a fairly small royalty, though. This one generates something like 500,000 to 750,000 a year. This is a small one. Looking into the future, a copper royalty we have over the Santo Domingo project is a big part of our growth. This royalty is owned by, or the mine, excuse me, is owned by Capstone Copper. And this is a project which is shovel ready, fully permitted. And the next steps, as can be discussed by Capstone Copper, are to number one, bring in a financial partner. Number two, next year is be the earliest final investment decision to proceed with construction. And then the third key sort of value catalyst, as we see it with this royalty, would be first income. At full production, this royalty generates a steady state income of around $30 million per year. That's assuming long-term copper today of around just under 450 per pound, which is not too far away from 10,000 per ton. And because, of course, as we just discussed with the royalty model, you sort of benefit from the nominal price without the cost impact, then this is a royalty that could see us do a lot better just with inflation.
Right. So again, talking to my viewers and listeners again, and of also evaluating, and I'm going to ask Mark this in a second, in evaluating a royalty company. What I also like to see really where their assets are, and I'm going to ask Mark what percentage of the royalties, if you can't discuss that, do you have on the different projects, specifically here with copper? How do you negotiate that, and what have you negotiated on? And then really, how do you find for future growth? How do you find the next project? What's your evaluation process?
Yeah, so why don't we just take those one at a time? So the first is, what does the portfolio look like? So as I mentioned today, 80% roughly is base metals. And of that 80%, 50 is copper, which leaves roughly 30 split between cobalt and nickel. The other 11% would be specialty metals and uranium. That's primarily vanadium, uranium, and some rare earths. And then the last 10%, just under 10%, would be bulks and other. That would include things like the met coal royalty, which is now a fairly small portion of our net asset value as estimated by research analysts, iron ore, chrome. In terms of the producing portfolio itself, as a percentage of our total net asset value, again, from what the analysts calculate is the individual parts of Ecora, so the value of each royalty. Research analysts estimate that around 55% of the value of this portfolio is in assets that are already generating income. So in other words, to the point that you mentioned earlier, the majority actually of the value in Ecora is on mines generating cash flow in production, but still with a good amount of value to near-term development stage, sort of longer dated expert development, and then earlier stage exploration. And the geographic exposure is something we've really been careful to target jurisdictions that are really established mining jurisdictions, because as a royalty company, your royalty is over a mine or a project, and therefore good title to the mining company and indirectly to Ecora is really important. So our portfolio today is approximately 85% OECD in Brazil, which are very well established mining jurisdictions. And then the two key exposures outside of that are to Zambia. Our copper stream in Zambia is in a province called the Copper Belt. So that'll give you a clue as to what they do there. And in South Africa for rare earths exposure, which we believe our rare earths exposure over that project is one of the best undeveloped rare earths projects globally outside of China. So it gives you a feel for where we are. Places where all these places are places we would go ourselves, and we do go visit these assets. All places where I'd be very comfortable taking my family. I've been to Zambia, I've been to this mine, we've been to South Africa to visit this rare earths exposure, which is actually very close to a beautiful park. And part of the attractions of the rare earth project is that they will clean up what is otherwise a legacy environmental concern. So all very positive news there. And then last, and when we think about our portfolio, is cost curve positioning. And this is something that's really important as a royalty investor. If you're buying a royalty, the likelihood of a project staying in production, if it's already in production, or the likelihood of a development stage project coming into production is very much highly correlated to the economics of this underlying project. And therefore, we really target assets or projects that have or are expected to have very low operating costs relative to other producers of the same commodity. And you can see that when you look at our portfolio from the investments we've made. 80% of the exposures we have are over mines or development stage projects that are expected to operate in the lowest half of all global producers for those individual commodities. So it's a very defensive way to position a portfolio. I think if you complement the royalty model and low cost exposures, that's really when you're best positioned to have a portfolio that shines over the long term.